Hi, Norman Hallett here with your next 4-minute drill for traders. We spoke last week about the trading opportunities in the crude oil market, considering the fact that the market has dropped below $50 a barrel. First, I want to thank all of you for all the great suggestions about how to trade a market at this kind of low. And last week, I also promised to share with you a trading idea of my own for crude oil that my friend Matt thought was crazy, but I saw some merit. So I wanted to first say that I'm not recommending that anyone follow this advice, and that if you do, make sure you have nerves of steel and a large account. With that in mind, the method for the trading of these kinds of markets like crude oil at this price is called scale trading. And this only works for commodities, physical commodities, things that are grown or mined. Basic economics says that when the price of a commodity gets too high, what happens is that producers rush to get product out at this high price, and eventually the supply curve overtakes the demand curve and the price starts to come down. Now, conversely, when the price of a commodity gets very low, like the crude is right now, it's not worth producing, and the supply starts to dry up, and eventually the demand curve overtakes the supply curve and prices start to move higher. A scale trader waits until a market is at 10 or 20-year lows and starts trading a scale. So, for instance, here's a $1 by $1 crude oil scale. You wait for crude to get to, say, $45, and you buy one contract. If the market continues lower, you hold the first position and buy another one at 44 and another at 43 if it keeps going down. When the market rallies back, say to 44, you sell the one you bought at 43 at 44, and if it continues higher, you sell the one you bought at 44 at 45. Then if the market heads lower again, you rebuy the 44 and then maybe the 43, and then with a rally you sell the 43 at 44 again. So what you're doing is you're buying one contract every dollar down and selling one contract every dollar up. That's a 1-by-1 scale. Now when the market crosses 46 in my example, to the upside, you're selling your final contract, the one you bought at 45, and you're out of the scale. Now what's crazy about this kind of trading, even though it's based on solid economic theory, is that you're limiting your gains and you're letting your losses run. The opposite of what every smart trader would suggest that you do. Not only that, but if the market takes a plunge to, say, $39, you'll be holding 6 positions at big losses. So if you attempted this, you must have big staying power. There are other negatives to this, not the least of which being what happens when the futures contract expires and you have to roll to the next month. You have to lift your basis on all your held positions when you roll. And some commodities have wide seasonal prices like the grain, so rolling may cause real price damage. That's not the case with crude. If you think about it, this would work great in a choppy market as you're buying every dollar down and selling every dollar up and accumulating money along the way to cushion a fall if that were to happen. I've seen this system work, and I've seen the strongest of traders bail out because of the pain, only to see the market eventually come back weeks or months later as the economics takes over, and that tells you that it would come back. That would not work with stocks or currencies. So stay away from stocks or currencies, as they can go to zero, but crude can't, and corn can't, and gold can't. So if you look back on the charts to see if I'm crazy as I sound, just make sure you're looking at commodity charts. You can ease the potential pain by trading the smallest contract size for the commodity, like they have half contracts in crude, and you can widen your scale, say 2 by 2, so you're only buying every $2 down and selling every 2 up, but you still need deep pockets. Now I wanted to tell you about the pleasures and pains of the potential of scale trading, because when prices get to decade lows like crude is, someone always comes out with this type of trading, and I wanted to give you the pros and the big cons. There are many different variations to this type of trading, and I was actually considering doing a class on it because of the sense that it makes based on economic theory, but decided to cover it first as kind of a trial balloon here, kind of an outline of it. in a longer than normal 4-minute drill. So I'm sorry I went over time a little bit. Okay, that's it for now. Hopefully you see why I'm intrigued with this, and also why my friend Matt over at Optimus thinks I'm absolutely nuts. Got a comment? Let's hear from you. Don't be shy. I can take it. Tell me if I'm crazy. Tell me what you think. I'm ready. So until next week, stay disciplined.